It's Black Friday for sterling, but it's really quite a beautiful day here on Wall Street as the world's financial community tries to work out what to make of Britain's stunning vote to leave the European Union. Now, the consequences for the UK itself are obviously profound. Today, I've been to talk to Marc, Chandler, the head of foreign exchange strategy at Brown Brothers Harriman, about the next steps, the next shoes to drop across the rest of the world, because this will reverberate everywhere. We started by talking about Japan. This is what has happened to the yen, which the authorities do not want to get too strong. Under Premier Abe, it has stayed above 100 yen to the dollar, but it briefly dropped below that level on Friday morning. Might the Bank of Japan intervene?
The G7 just issued a statement that basically reaffirmed their adversity to volatile and unorderly markets. And if there's a definition, even though we might not all agree on what the definition is, we sort of know it by looking at it. This is a disorderly market. It's very volatile. So I think that the bar for BOJ intervention has been lowered by the recent G7 statement and the price action. So while in the past I've been very suspicious that the BOJ would not intervene, now I recognize that these kind of market conditions make BOJ intervention more likely, but I think the first line of defense will be these currency swaps that were developed during the great financial crisis. It might be used at the first blush. So I don't think the BOJ intervenes, but I think the risk is increasing, especially if we go back below 100.
Then there is Europe, where the next big event is Sunday's Spanish election. Shares of Eurozone banks are tumbling, and Spanish bond yields are rising, while the yields on German bunds are falling. A classic signal that traders are worrying about a return to the Eurozone sovereign crisis. What could happen next?
I think that the election is going to be, already before the election, we knew that Prime Minister Rajoy is probably not going to be able to serve another term, because the conditions for him to have a coalition partner would be the dismissal of him and another candidate from the PP, from his popular party. So I think that instead what happens is that, partly as a reflection of what happened in the UK, but partly because of Spain's own dynamics, new center-left party is rising and the old two-party system is breaking down. And so we could see a center-left coalition if the socialists can agree to letting the Catalonians have their own referendum on independence.
Beyond the risk of cascading plebiscites in Europe, in the US, there's the eternal question of when the Fed will raise rates. Now, amazingly, the Fed funds futures market thinks there's more chance of a cut than a hike.
Yeah, so I think the market has completely gone away from a July move. They had been pricing in a small chance for a move before the end of the year, but that has been taken back now. And there's a small chance, more of a chance of a cut than a hike at this point. And so the market is saying that the disruption of the global financial markets, the tightening of financial conditions, is going to change the trajectory of Fed policy. And this is in the context, though, of everything that's going on. So I think that if the UK would have stayed in, and we got a strong jobs number in early July, things could have been different. But now, under these circumstances, it seems that a Fed rate hike this year, very hard to conceive.
And if there's ever a risk of a crisis, it's in emerging markets where dollar strength tends to overlap with emerging market weakness. Brexit makes the dollar stronger.
For me, the key linkage here is not so much dollar strength, but it's really uncertainty in the world. And uncertainty in the world, the dollar strengthens, but so does the yen. But people don't talk really about how the yen and South African rand are inversely correlated. It's really about the dollar. But I really think the underlying this is risk off. And I think this is what's hurting the emerging markets, and not just the bad emerging market countries. They have big current account deficits, budget deficits, weak political system, but even fairly solid emerging market countries, say like a Mexico, where 90% of the banking assets are in foreign control, foreign hands. The fear that many people have in the back of their minds that the UK leaving the EU is like a bit of a canary in a coal mine. That this is a warning that the nationalist forces throughout Europe are rising and could still split up Europe.
Ultimately, as I think is now clear, the financial repercussions of this are going to be felt elsewhere, and they're not all going to be felt at once. We're going to be talking about this and analysing this for months and years to come. But we're going to have to get through the short term first before we can get to the long term. There are some very exciting days in prospect.